24 hours ago, your screen was a crime scene. Silver at $82, blood red candles, margin calls detonating everywhere, retail accounts blowing up in real time, brokers were force selling positions, news tickers were screaming, safe haven trade is over. Talking heads on CNBC and Bloomberg were smirking, telling you to dump your silver and run back into overvalued tech stocks at all-time highs. And a lot of people did it. They sold the exact bottom of an algorithmic bear trap. They handed generational wealth to Wall Street at the cheapest price the machines could engineer. But if you held your physical, if you didn't flinch, if you understood that the paper price was having a panic attack while the metal in your hand didn't change, you just survived the most important stress test of the 2026 silver bull market. Because today, we're not at $82. We're sitting right around $85, a violent V-shaped reversal in less than one trading day. The forced liquidations are done. The T+1 margin calls have been met, and the same Wall Street algorithms that were dumping yesterday are buying back today. This video is about one thing, why that $82 candle was not the end of silver, but the beginning of a new phase, where smart money quietly reloads and retail either learns or gets wiped out again. Stay with me. I'm going to walk you through how the $82 crash actually happened, why the bounce to $85 was mathematically inevitable, what Operation Epic Fury and the Asia meltdown have to do with this move, and why every big desk is now drawing the same line at $95 as the next critical trigger. Segment 2, before we go deeper, I need to say this straight. This is information and education, not financial advice. I'm not your financial advisor. I'm not selling you a course, a private group, or a magic indicator. I'm here to explain the mechanics behind what just happened so you're not blind the next time the machines attack. In return, I want one thing from you: data. Drop a comment right now and tell me honestly, did you hold physical through the $82 crash? Did you ride the bounce to $85, or did you panic sell at the bottom? Your experience is field intelligence. 6 months from now, when we look back at this moment with silver at 3 digits, I want a record in the comments of who held the line and who got harvested by the algorithms. All right, let's break down exactly why yesterday's smash looked like the end and why it wasn't. Segment 3. What really happened at $82 yesterday's selling was not organic. It wasn't millions of investors simultaneously losing faith in silver. It was a liquidity event, a mechanical flush driven by the structure of the futures system. Here's the sequence in plain English. Institutions were heavily leveraged long and short in silver futures. The US dollar index spiked hard, about 3%, as capital fled collapsing Asian markets and rushed into dollar cash. That dollar move triggered strict T+1 margin requirements on futures positions, meaning big players had 24 hours to post more collateral or get liquidated. They didn't decide to sell because they hate silver. They were forced to sell because the clearinghouse doesn't care about your macro thesis. It cares about cash. So the algos flipped into emergency mode, dump any silver contract at any price, raise cash to satisfy the margin call, do it fast before settlement deadlines hit. That's why volume exploded to insane levels. More silver's contracts traded in a few hours than you normally see in an entire week. Price dropped like a stone from the high 80s straight into the low 80s. Retail traders on margin got wiped as their stops and liquidations chased the algos down. This was not the world is dumping silver. It was the plumbing of the system breaking for a day. And while all of that was happening on screens, the physical market told a totally different story. Segment 4. Paper crashed, physical froze. While price on COMEX was printing $82, try this experiment. Go back and look at what your dealer was charging for real metal. In market after market, dealers were pulling inventory from their websites. Premiums on Eagles, Maples, and generic rounds were spiking, not dropping. In some places, you literally could not buy at $82 because dealers refused to sell into what they knew was fake pricing. They didn't believe the screen, they believed the supply, and the supply was tight, so they locked their shelves. They waited for the paper storm to blow over. That's your proof right there. If this was a real fundamentals-driven collapse in silver, physical would be everywhere at fire sale prices. Instead, physical disappeared as the paper price crashed. That's not a market discovering fair value. That's a system glitch being exploited to shake out weak hands. And the moment the T+1 window closed, the moment forced liquidations were done, the buyers came back. Segment 5. V-shaped math. Why the bounce was inevitable. Look at today's price action. We didn't grind back up over 2 weeks. We snapped from $80 lows back to around $85 in one aggressive vertical move, a classic V-shaped reversal. Why so fast? Because nothing macro improved in the last 24 hours. The Middle East is still on fire. Operation Epic Fury is still ongoing. Asian equity markets, especially South Korea, are still getting smashed. Foreign capital is still fleeing emerging markets and looking for somewhere, anywhere, safe to hide. When the forced selling stopped, that capital did what it always does in a crisis. It ran into gold and silver. The same algos that dumped yesterday flipped to buy the panic mode today. That's why you're seeing a $3 move in a single session, roughly a 10% bounce off the bottom. Relentless green candles, not choppy noise. That is classic institutional behavior. Use a mechanical flush to scare retail out, accumulate from their panic at the bottom, then ride the reflex bounce built on the same macro fears that never went away. The $82 candle was not silver dying. It was the exhaustion point, the place where forced sellers ran out and real buyers stepped back in, and now that level is burned into every serious trader's chart. Segment 6, $82, from horror to new floor. In technical language, what happened at $82 is simple. The market printed a capitulation low, then violently rejected it. That low now becomes a major support zone, a line in the sand for every algo and every human trader watching this market. Every institutional desk has drawn the same horizontal line, $82. If price ever comes back there, they know two things. That's where forced selling previously exhausted. That's where physical supply vanished and dealers shut the doors. So what do big players do with a level like that? They mark it as buy zone of last resort. They use it to size risk. They start planning entries above it. Once a floor is confirmed, the game shifts from how low can this go to how far can this bounce run before it meets serious resistance. And that's where the next critical number comes in, $95. $95 is the level every institutional desk is now watching. It was a key high during the January rally. It sits right below the psychological triple-digit barrier. It's where a ton of call options are stacked, waiting to ignite a gamma squeeze if we break through. The path from 82, 85, 95 is now the basic roadmap for silver in the short term, and Wall Street knows it. Segment 7, the next battle, $95 and the options. Minefield. Let's talk about $95 because that's not just a random number on the screen. Above that level, there's a wall of call options, strikes at 95, 100, and higher. Those calls were sold by market makers who now have to hedge if price moves toward them. Here's how this can turn into a squeeze. Silver pushes up to say 94, 96. Call options start going deep in the money. Market makers who sold those calls are suddenly short gamma. They lose if price keeps ripping. To protect themselves, they buy futures, which pushes price up further. Higher price activates even more calls, forcing even more hedging. That feedback loop is called a gamma squeeze. We saw it in nickel in 2022. So violently, the London Metal Exchange literally shut trading down. Silver has the same mechanical potential, tight physical supply, heavy options positioning, huge global macro stress. If we break $95 with real momentum, the move to 100 plus could be explosive, not because of Reddit memes, but because of how the options and futures plumbing works. Will COMEX try to slow it with circuit breakers, margin hikes, volatility controls? Probably, but those don't fix the underlying problem. There is not enough metal at these prices to satisfy real global demand. Delaying the move just makes the eventual repricing more violent. Segment 8, geopolitics, de-dollarization, and why Wall Street wants your silver zoom out for a second. The $82 crash and $85 reversal are just one frame of a much bigger movie. In the background, Operation Epic Fury continues in the Middle East. Shipping lanes, oil flows, and risk premia are all under stress. Asian markets are cracking. South Korea, Japan, China feeling real pain. At the same time, the US runs trillion-dollar deficits every year. National debt approaches $40 trillion. Interest payments are now bigger than the defense budget. Globally, countries are building alternative payment systems outside SWIFT, doing energy deals in yuan, rubles, and local currencies, increasing gold purchases at the fastest pace in half a century. This is de-dollarization. Not theory, but documented policy. When trusted money dies, capital runs to hard assets that can't be frozen or printed, gold and silver. Wall Street understands this perfectly. They see the same debt charts. They see the same BRICS policies. They attend the same closed-door briefings. That's why they were willing to dump silver at $82 yesterday and buy it back at $85 today. They're not thinking about a $3 day trade. They're positioning for potential systemic failure in the currency architecture over the next decade, but they can't say that on TV, so they do it quietly behind the smokescreen of volatility and liquidity events. And every time there's a paper smash, they hope you panic so they can accumulate more at your expense. Segment 9. What this means for you. So what do you actually do with all of this? I'm not going to tell you buy now, sell now, or all in at 85. That would be irresponsible. But here's what you should absolutely come away with. Understand the difference between paper and physical. Paper silver can drop 10 to 15% in a day because of margin calls and settlement rules. Physical silver does not evaporate. During the crash, real metal actually became harder to get and more expensive in premium terms. Understand what $82 and $95 represent. $82 is now a confirmed exhaustion low, the bottom of a forced liquidation, not a vote against silver. $95 is the next battlefield where options, futures, and sentiment collide. Understand who is on each side of the trade. Panic sellers, over-leveraged retail, short-term traders, people who only watch the headlines. Accumulators, institutions, central banks, long-term stackers who see the currency and geopolitical picture. If you hold physical, yesterday's crash didn't change your ounces. It just stress-tested your mindset. If you folded, learn from it. If you held, recognize what you just passed through. An algorithmic gauntlet designed to separate you from your hedge right before things get really interesting. Segment 10, closing. Stay ahead of the next trap. If my breakdown of the $80 crash and $85 reversal helped you see through the noise, here's how you can support this work. Hit like so this message reaches more people who almost sold the bottom. Subscribe and turn on the bell so you don't miss the next real-time breakdown when we approach $95 and those options start to ignite. Comment with one word that describes your reaction to the crash. Held if you stayed in. Shook if you sold. Learning if you know you need a stronger plan next time. This market is not fair. It's not neutral. It's a rigged casino where the rules change mid-hand, and silver is one of the few chips that can't be printed on demand. You don't beat that system by guessing every tick. You beat it by understanding the mechanics, knowing the macro, and refusing to play the game on their emotional terms. The $80 crash was a warning shot. The $85 reversal is your signal. Next stop on the map, 95, and the gateway to triple-digit silver.